Good morning. Today, we are analyzing a pivotal move by OMRON Corporation, the 81 billion Japanese yen carve-out of its Device and Module Solutions business, or DMB. This is more than a simple divestiture. It is a calculated, strategic recombination announced on March 30, 2026, aimed at accelerating OMRON's next growth phase while establishing the newly branded Aratus Corporation. For an organization like ours, this deal serves as a benchmark for how to handle quote-unquote foundational business units that require a different capital velocity than the parent company. By separating DMB, OMRON is signaling a shift toward extreme specialization, ensuring that both the parent and the spin-off have the specific management focus required to win in their respective and now diverging markets. Looking at the mechanics, the transaction value is set at 81 billion yen, representing a significant multiple of the business's 68.8 billion yen FY 2025 revenue. The seller, OMRON Corporation, will divest 100% of DMB assets via an absorption-type split. The buyer is the Carlyle Group, executing the acquisition through a special purpose company, TCG 2602. Crucially, this is not a total exit. OMRON is making a 5% strategic reinvestment in the parent SPC. This, quote, stub equity ensures operational continuity and preserves critical sales synergies, allowing OMRON to benefit from Aratus's future upside while offloading the massive capital expenditure requirements to a partner better suited for high-stakes industrial scaling. Why now? DMB is OMRON's foundational core, dating back to 1933 with the production of X-ray timers. However, the market has shifted. We see two primary catalysts: the rapid global expansion of EVs and surging demand for high-capacity relays. While the opportunity is massive, OMRON faced competitive constraints. Agile Chinese competitors are moving faster, and the capex required to maintain market share has become unprecedented. OMRON realized that its internal capital allocation process could no longer match the required investment velocity. This carve-out is a proactive admission that a legacy business unit often needs, quote, external capital intervention to escape the gravity of a large corporate parent and compete with localized, nimble rivals. OMRON's choice of the Carlyle Group as a partner is highly deliberate. Carlyle has maintained a continuous, active presence in Japan since 2000, demonstrating a deep understanding of local corporate culture and a long-term commitment to the market. Beyond just capital and speed, Carlyle brings proven execution expertise in post-carve-out restructuring and global expansion for manufacturing entities. They provide the massive investment injections required to outpace competitors in the EV and energy sectors. For OMRON, Carlyle isn't just a buyer. They are a sophisticated operator capable of taking a Japanese jewel and polishing it for a global stage, providing the technical and operational heavy lifting that a diversified parent company often finds difficult to prioritize. The divergence framework illustrates the post-deal focus for both entities. OMRON will now concentrate its capital and management bandwidth strictly on industrial automation, IA, and data services, following their SF second-stage midterm roadmap. Meanwhile, Aratus Corporation will pursue aggressive scaling under the leadership of Masahiko Izaki, the planned representative director. Aratus now has unlocked capital for R&D in EV mobility and green energy infrastructure, investments that might have been diluted within OMRON's broader portfolio. The 5% reinvestment acts as the bridge, maintaining a stable transition and ensuring that the long-standing sales relationship between OMRON's automation business and Aratus's components remains intact. Structurally, the deal follows a 4-phase process to ensure a clean break with minimal disruption. Step 1 involves the absorption-type split into OMRON Device Company, to be renamed Aratus, on July 1, 2026. Step 2 is the transfer of 100% of those shares to the Carlyle SPC, TCG 2602. Finally, in Steps 3 and 4, OMRON executes its reinvestment into the parent SPC, resulting in the final ownership structure of 95% Carlyle and 5% OMRON. This multi-step approach allows for the reorganization of both domestic and overseas subsidiaries, such as the units in Kumamoto and Shenzhen, into the new Aratus Group structure before the final change of control occurs. Finally, let's look at the timeline. Following the board resolution on March 30, 2026, we move toward a general shareholders meeting for the successor company on June 24. The legal carve-out becomes effective on July 1, 2026. The final financial closing and share transfer are slated for October 1, 2026, pending regulatory clearances. A key detail for our own planning. OMRON utilized a, quote, simplified absorption type split under Article 784, Paragraph 2 of the Companies Act, meaning OMRON's own general shareholder approval was not required. This significantly streamlined the execution phase, allowing the board to move with the, quote, business speed they identified as a critical deficiency in their previous structure.